There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Charles Schwab. I'm on the line with Sheldon McIntyre, founder of the 360 Virtual Advisor. He has more than 14 years of experience in the investment industry. How you doing today, Sheldon?
I'm doing okay. Yourself?
We're doing good. Welcome back to the show. Now, I think the last time you went on the show, or you were on the show, you had a trip planned to the House of Mouse, a trip planned to Disney World. How was that trip?
It was excellent. It was very good, actually. My daughter enjoyed it, and her cousins enjoyed it. But in my case, 10 days of Disney World is enough.
10 days is enough. Okay. Did you go to Blizzard Beach?
My daughter and wife did. I did not, actually.
I hear that's really fun. That's what I'm like. That's on my
I
bucket
took a day
list.
off.
You took a day off out of the 10? Okay.
Yeah.
And you also
Went down to the ESPN restaurant, watched some soccer, sports.
Okay, good. A little bit of quiet time there away from the park.
Exactly.
All right. Now, you also mentioned that typically when you go on a vacation or something like that, that you get pretty flat. That you just kind of like to be able to relax and focus on the family. Boy, your timing might have been pretty good on that, huh, Sheldon?
Yeah, actually, it worked out all right. I went on vacation. I held one trade for our model portfolio, and for myself, I actually closed everything before I left. I guess I was in GoPro. I guess I missed half of that move, but I took a 40% gain approximately, and we held a short position in the Russell 2000 through the vacation time.
Could you talk about that GoPro trade and kind of remember if a stock goes up so much in a period of time that the expectations are for it to go far, continue on? Could you talk about that setup?
Well, yeah. Basically, when a stock advances about 20% in just a few trading days, usually 10 days or less, what you want to do, of course, if you're a swing trader or a longer term trader, is you want to put that trade aside and give it a little bit more time to see how far it can go. Breakouts of 20% or more in a short period of time, breaking out from a solid and constructive base, tend to go a lot higher. And in the case of GoPro, that was one that really played out well. Basically 100% gain in a very short period of time.
So where did you? So I see the base there, and where did you end up entering, and where did you end up exiting?
Well, I took the trade at 48.50, 10 cents above basically the IPO price. It was a couple days afterwards where it peaked. Sorry, 49.90 and 50. And I actually got out on the 10th. Just about 70.40, I believe, was the price.
Oh,
So,
okay. All right.
yeah.
Wow. And did you just exit the whole position? That was your target, and you got out, or did you piece out of it?
No, I got out completely. I tend to all in, all out
Okay.
when I trade, particularly when a stock is showing that kind of power, and also when I'm leaving on vacation. There's no sense me fighting for a few more pennies or a dime.
And that's just technically based. You don't care. The fundamentals don't mean squat to you on something like that.
Generally, when it's an IPO base like that, I'm functioning on fundamentals, or sorry, technicals. I really liked how that's set up. You had the left side, then basically made a flat base, and volume really dried up at the lows, and then accelerated as it went up the right side, and then you had the volume continue to accelerate as the breakout continued.
Okay, so you got back from vacation. You're flush with cash. Now you must have been back really before this Ebola stuff really started getting into gear, correct?
Yeah, yeah. I really don't pay much attention to that. I think that's just peripheral noise. It doesn't affect my trading or doesn't factor into my trading decisions at all.
Okay, so but it did give us really some unprecedented volatility, that 10% correction that everyone was looking for. Were you able to position yourself, accordingly, from that decline, or were you more active once it had looked like we had made a bottom and started to come back up?
I wasn't overly active in the decline, but it's important to point out that the Ebola and some of the other peripheral news that were taking place that were negative with the European community, economy, etc., was that the market was already vulnerable. When I left just before vacations, I published a short post on See It Market where I said it was a bend or break moment for the market. And really, the underlying thesis of that was the deteriorating fundamentals, particularly the number of stocks that were trading above the 200-day moving average, and also really the declining participation of the small and mid caps. So the market was vulnerable to decline, and it really, anything would have set that off. Usually, the news follows a technical situation or a market internal situation, and that's what we saw. We did not break, but we did come very close to breaking on this move down. I would say that it was a big bend.
Okay.
And in terms of positioning, I did have a couple of shorts. Like I said, I did hold my Russell 2000 short because it was the weakest and it was not confirming the new price highs of the larger indexes early in August. So I was very negative on Europe at the time, and I anticipated that we'd see a test of the 200-week simple moving averages on the ETFs, and several of those actually ended up doing that, as well as some of the continental indexes in Europe. We actually hit a bear market in some of the ETFs and very close in 20% decline in the continental indexes of Europe. So I had a couple shorts. I had a short in Europe, GRFS. I had a short in COG. The oil space took a pretty big hit. And that's about it.
Okay, coming out of the chat room here, we have a question, and this is saying: Is Sheldon seeing more positives for the market in his charts and potential setups expanding?
I'm seeing a mild expansion in setups. One of the things that you have to take note of is when the market internals really deteriorate like they did, for example, like the number of stocks trading above the 200-day or 50-day moving average, is it takes a while for stocks to rebuild their bases and assert themselves in the market. So, for example, at this point, I'm sitting at about 60% invested. I have been, a little bit cautious, targeting really high-quality stocks with solid price structures. I have not been, yesterday did see a little bit of a jump in the number of stocks meeting my criteria, but I would not say that I'm overly bullish based on that number.
Okay, all right, and just following up on that, is the chemical barometer bull-bear ratio showing signs of more upside?
Good question, and actually, it was released yesterday, the newest one, and it declined slightly from September, but it still projects a solid, consistent growth into the middle of next year at least. So, which basically you see in the yield curve and also in the general economic numbers in the U.S.
Okay, and just overall thoughts on the market here.
Well, we got the FOMC meeting coming in today. I don't think we're going to see much change in language there. I would assume they're going to keep policy the way it is for an extended period of time. I do think, though, that they want to raise rates very badly when you're looking. They have really no gunpowder left if the U.S. economy goes into recession. I think that based on what's happening in Europe right now, they need to keep things the way they are. I mean, it's one of the interesting things is that if you plot sort of the verbal easing comments since about early October, you will see that the market has gapped every day on a positive verbal easing comment, whether it's out of the EU, out of the United States, and even China. So, I think the central banks got a little bit worried, and I would say that, to put it in a simple way, is that the child that they have created, was suffering a little bit, and they had to protect the growth of this monetary policy driven advance in the markets. So overall, I think we should consolidate at this point. Maybe for a couple of days, I would watch the volatility index after the FOMC meeting today. If volatility picks up, I would look for some type of sell-off into the close, which wouldn't be a surprise. And to be honest, the compressed move that we've seen needs a few days to release that compression. And that would likely lead to an expansion in the number of stocks meeting my criteria.
Okay. Anything in particular on your buy radar?
Baidu, I like.
Okay.
It does have earnings after the bell. Baidu is BIDU.
Okay.
It does have earnings after the bell today, but it does also have a high probability of beating and also seeing decent gains post earnings report. I like a few semiconductor stocks like OVTI, LRCX, and SWKS. I like the biotech space, but a lot of those stocks have all already broken out. And a post that I wrote for See It Market should be published today, where I break down some of the trades that I've done in those biotech stocks.
Okay. And anything on your sell radar?
My sell radar? No, not really. I like the price action of the stocks that I've initiated trades in. For example, like an ANAC, CELG, MANH, AKRX. The price action has been very good, and in fact, most of those stocks were printing new breakout highs yesterday. So I'm not eager to sell anything that I own at this point, and I'm not interested in shorting.
No, not at all. Hi, and what
No.
are you looking at? What are you looking for out of the Fed?
Well, like I mentioned before, just a continuation of the same language, the same monetary policy for an extended period of time. And I think that will carry through into the new year. But like I said, I think they want to raise rates some in order to create a war chest. And in the case that the U.S. economy looks like it's veering towards a recession, at this point, they really don't have much. I do find it interesting, though, that the Dallas Fed president, I think his last name is Fisher, back in September, articulated how, if the markets were going to test the ECB and the Fed as this latest QE round was ending, and whether the ECB was willing to step up to the plate. And I think at the end of the day, the ECB is going to have to, and that should alleviate some of the pressure on the Fed moving forward.
Does it worry you that really, that Europe is really dragging their feet? They're talking about QE, no QE, but really, we're like the safe haven here. Do you think that eventually is going to have, a drag on the U.S. stock market?
If they don't go big, maybe we will have to go home. I think they have no choice. I think they're going to have to get into sovereign debt purchases, because that market really is the largest in Europe in terms of having an impact on the overall economy. I think that really the Germans are the obstacle. We all know that they're very worried about inflation, always and have been for decades. And I think they are an obstacle in this. I think that there's going to have to be some quid pro quo in the short term in order for the ECB to be able to adopt a more aggressive policy, probably in the new year. If it doesn't happen, obviously we should be concerned about that. I think really Europe is the sort of the dark cloud over all the global markets. I don't see Japan as one. You could argue China to some extent, but for me, really, Europe stands out.
Okay, Sheldon McIntyre, founder of the 360 Virtual Advisor, sharing some of his wisdom here from his 14 years in the market. Sheldon, thanks for coming on as usual. We hope to speak to you again soon.
Thanks for the invite, Joel.
Okay. Sheldon
Have a good day.
McIntyre.